Good morning, everyone. This is Joe Scarice, your co-founder and co-host to the Creative Bird Strategies House and podcast brought to you every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and strategy. So we're going to get rocking and rolling in here in just a few minutes. We're going to invite some peeps up and we'll, get started with our discussion this morning, which is the Section 8 loophole in real estate investing. So we're going to get rocking and rolling here in just a few minutes, and we'll get people invited in, and we'll get started here. I'm really proud to say that Yordell and I have had a consistent viewership of 3,000 plus views to our podcast every Sunday morning, post production, every single week for the past 6 months. So I want to thank everybody's participation, their time that they give back, just everything. Just because this is great content. You can't make this content up. It's really a wonderful environment, which I'm really happy about. So I'm going to start inviting some people in so we can get started here in just a few minutes. But in the meanwhile, I want to thank our sponsors, as always, Mr. Yordell Perkins of Perkatech, who provides all the social media architecture and website work and video work. I mean, he's just been just a great friend and asset and business associate for the past decade now. We're celebrating our 140th or so podcast. I was a little off last week. We're at 140 podcasts right now. So we're going to keep pushing this. We're going to get to that 150th. Then we're going to get to the 200th, probably about sometime between the first quarter or the end of first quarter, because we're also doing Saturday morning podcasts on second Saturdays, doing one-on-one interviews. So that's going to tie into this podcast as well. You can find everything on the creativebirdstrategies.com website. I'm just inviting some people in and get started here in just a couple of minutes, and we'll get into insights in the market this past week. Visited quite a few places this past week. Um, networking with investors, having discussions. Interesting. All the discussions we're going to have on Section 8 today, all the discussions are posted to my LinkedIn newsletter, the Creative Bird Strategies newsletter. So if we're not connected on LinkedIn, we should be, because those newsletters, we're putting out a lot of content every week of articles, but 3 articles were posted today in regards to this discussion this morning. I also want to thank MB Capital Solutions, I am a referral partner for them. I work side by side with them in regards to unsecured business lines of credit. I want to thank Lend Investors Capital, where I am a regional vice president of sales, providing white label for brokers to be capital partners with me, referral partnerships where I can pay marketing fees back to the referral partners, such as real estate professional services and agents. And then we're direct to investor. This is in DSCR 1 through 4, 5+ units. We provide also fixed to rent, fixed to flip, new construction on all the following as well. We are nationwide. We have pure white label product for brokers that would like to get into the broker space. I would be your direct account executive. If you'd like to have that deep discussion, we do have a couple of our capital partners up as moderators this morning as well. So let's get into some news of the articles today, the things that have caught my eye this past week. Q3 GDP is close to 4%, kind of hanging around there a little bit. We're not doing fantastic. We're not doing bad. We're right there. The Fed won't get key inflation data before next rate decision. So, the October CPI release is late because the government shut down. So it'll be really interesting to see what the Fed does. But right now, rates have been kind of like just sitting around. They're not really making a lot of moves. But a lot of the Fed shares really believe there's further adjustment to the rates. So we're probably hovering around in the sixes, depending on credit, light sevens, but really sixes is the number on DSCR, fixed to rent, fixed to flip. Bank rates around 6.38. We're probably near equivalent. We're dead even. Really, what the difference is between bank rate now for investors and non-QM lending is really the 30-year fixed money, the lack of need of tax returns and pay stubs and W-2s and 1099s comparably to banks and credit unions that need a full file. So that's really separating a lot of self-employed real estate investors to kind of lean toward the non-QM space. Um, September job reports are cooling a little bit. Still growing labor market. So it'll be interesting to see a lot of this money that's being brought it back into the United States by the current administration, and see how that bleeds into the job reports probably by second or third quarter. I mean, there are a lot of announcements of trillions of dollars coming back into the country, but that doesn't overnight doesn't make things happen. But I think that for that second quarter could be magical for some markets throughout the country, especially in the job markets. Some market trends that caught my eye this week. Homebuyer regret falls sharply as market slowdown boosts confidence. Um, Second article caught my eye is new home listings rise toward pre-pandemic levels. And another article that caught my eye in market trends is mortgage originations dip in quarter three despite gains in refis and HELOCs. I'm seeing a lot of DSCR refis. The rates are, like I said, they're there. They're not, there's nothing magical about them right now. It's all about leverage. If you want 75%, you're paying for it. If you want 70%, you're going to get a better rate. If you want 65 to 60%, you're going to get the best rate out there. So you got it's common sense approach to the market. Let's see if there's any industry news that catches my eye. Oh, yes. There was a mortgage fraud case that came up in Philadelphia. I did post it to my Facebook. I will post it to my LinkedIn. A lot of mortgage fraud right now in some of these urban settings like Philadelphia and Baltimore, St. Louis, Chicago. They're all in on it. The buyer agent, the appraiser, the mortgage people. It's bad. And I see a lot of concerns with funding in a lot of these markets coming up in the near immediate first quarter. So keep an eye out for that in any of the urban settings. See here, see if there's anything else that catches my eye before we get into our discussion. Um, no, no, we're good here. So again, all these articles that I now am going to have on every discussion every week, they're going to be in my newsletter. So if you're not following me on LinkedIn or connected with me on LinkedIn, you're not going to see these articles. And I'm more than happy to send them to you, but they're on my LinkedIn, so you should just kind of follow me through there. So our discussion today, the Section 8 loophole in real estate investing. So we're gonna cover three parts of this between inviting our moderators to give insight to what their thoughts are, the loophole, and then maybe what do you need to know as a Section 8 landlord, and then finally I'm going to go into the top cities in the U.S. as a small real estate investor to identify for Section 8 rentals and some sleepers as well. So let's first go into Section 8 loophole in real estate investing. How savvy investors are leveraging the program for guaranteed rents, faster cash flow, and long-term stability. Um, they're while most real estate investors are familiar with Section 8 as a rent guarantee program, few understand strategic loopholes that can dramatically improve returns when used correctly. These are not illegal tricks. They're underused advantages within HUD own structure that smart investors tap into a stabilized portfolio, boosting cash flow and protecting a downside risk. Rents can typically exceed market in many areas. So the fair market rent in a lot of markets and payment statements often exceed what landlords can get from a regular tenant. So, like from a Section 8 perspective, I tell people your Section 8 rate might be the market rate. You can raise rents annually even when the market is slow. Section 8 operates on a predictable annual cycle. This means consistent rent increases even while market tenants push back or move out. There's a near vacancy risk. There's a vacancy risk is near zero. So if you're tied in with Section 8, the wait lists in many counties are very long. And if a tenant leaves, you can refill the unit almost immediately. This eliminates the biggest drag on cash flow and turnover. Tenants tend to stay 3 times longer in Section 8. HUD data consistently shows Section 8 tenants stay longer because of higher barriers to moving, secure subsidy, housing stability. This drastically improves NOI over time. Repairs and rehab can be structured into higher rents. If you improve the condition of the unit, new kitchen, flooring, HVAC, you can request a rent bump tied to the improved comparables to the housing authority uses. There's lower risk, a lower default risk, and higher DSCR scores. So I actually I see DSCR stronger in the Section 8 space than market rent right now. NOI, cash flow coverage, refinancing prospects, appraisal justification for income approach. And then there's strategic leasing. Not every unit has to be Section 8. Mixed tenant buildings allow you to optimize some units for Section 8, others for market premium rents. This creates a hybrid cash flow model that stabilizes NOI while capturing upside. Why most investors miss this loophole? Because they don't understand payment standards. They avoid the program due to old stereotypes. Don't know how to manage inspections. Don't know how to negotiate higher rents. Don't consult lenders that leverage DSCR benefits. The opportunity is in the program, it's the inefficiency. Brian, good morning. Thank you for your patience. Brief overview who you are, what you do, and thoughts to the Section 8 loophole in real estate investment.
Good morning. Thanks, Joe. Brian Guth in upstate New York, Rochester, New York to be specific, which I just saw an article come out, top 7, I believe, or number 7. I think it was a USA Today poll of value increase since 2019. So my wife and I, we do fix and flips, fix and holds, as well as Airbnbs. We have about 20 properties in Rochester. And from a landlord perspective, I think the biggest thing you mentioned was the stereotypes piece, and I agree with that 100%. A lot of the investors I spoke to, just in my travels, because I'm relatively new to them, in the game for probably like 3 to 4 years now.
Being attacked.
Get attacked. So it's. The stereotype is spot on, where some of the older investors I talk to, it's the element of, we don't want, they're not going to take care of the property, they're going to ruin the property, etc. And I have not found that. I found that typically they do take care of the property because they don't want to lose the benefit of the stimulus. So I completely agree with the stereotypes. I haven't had any issues. The majority of my properties, we have Section 8, or we have, so Section 8 is through HUD, I believe. We also have DSS, which are vouchers through, I forget, another government agency, but overall have not had any issues. Like you mentioned, with the rent amounts, it's dictated by the family size, and kind of how large the family dictates what property they are eligible for. I find their rents to be, or the amounts they pay to be very, very comparable, kind of in line with the market rents. I know some people strategize that they specifically do not want Section 8, so they'll list the rental price for $100, above what the DSS limit is. I'm sorry, what the Section 8 limit is. But I find we don't need to do that. Overall, no issue with Section 8 rentals. And like you said, the inspection piece, the inspection piece doesn't worry me, because I'm going to make sure I have a safe unit regardless. It just gives an added layer that, they're going to come in and need to inspect, but I have no problem with that whatsoever as a landlord.
Yeah, I mean, Brian, people have it's interesting. Rochester was such a hot market for so long, right? And now it's kind of like spreading out into Albany and Buffalo, and Syracuse is making a slight revolve. What's going on with Rochester? Is there just political issues? Is it the Section 8 issues? Is the market changing on everyone? Because I find like there's some more disgruntlement when I was up there at the expo with you. What's changing in Rochester compared to some of these hot New York State markets?
I don't know. Syracuse is getting influx. They have some government projects they landed. So I think there's some excitement there in Syracuse, which is about 60 miles to the east. Buffalo is, I think, a little bit bigger than Rochester, so that gets more attention. I think it goes in waves. Again, I'm relatively new to it, so I haven't been through all of the cycles that some of the other, seasoned investors have. But from what I'm seeing, it's still a hot market. There's still plenty of inventory. It's still a hot market. It's teetering between buyer's market and seller's market, where other areas have definitely turned into a buyer's market. But no, I mean, I've not seen much of a change, but again, I only have like a 4 year window to look back on.
Yeah. Well, but your wife's in the property management space. Is she seeing more inquiry in that space in the last 6 months to 12 months where investors are like, listen, just manage my property for me? I mean, it's the only way I'm going to be able to grow. Where do you see property management becoming more essential than ever for scaling?
I mean, that's to be honest, that's all I know. I haven't seen, and I when I talked to her, she was actually going to join, but she had to leave. That's what the dogs were barking. Um, it's been consistent, in that my portfolio is handled by a property management company, so they take care of the inspections. They have a team to do the inspections. They're the ones kind of making sure that the rents are in line to bump the rents, all those fun things. So to for me and from what I've heard from her, it's been consistent. Like there's a lot of the a lot of tenants they place are with Section 8.
Yeah.
It's your point you mentioned earlier. There is some administration with it. So, for the $100 per month, it's well worth it that the property management team cover that for me so I can focus on acquiring more.
Yeah.
Let them handle the day to day. Let me handle on the hunting.
Excellent. Right. Thank you very much for your insight. What do you need to know as a Section 8 landlord, right? The essentials for cash flow stability, compliance, and long-term success. There's some program basics, right? Section 8 is a federal program administered by the local public housing authorities, PHAs, that pays a portion, sometimes all, of the tenant's rent directly to the landlord. Some key benefits: guaranteed government-backed rent, lower vacancy risk, high demand in most metro areas, strong tenant pool in many markets. Some key challenges: slower lease up process, required annual inspections, and bureaucratic timelines. There's obviously a tenant landlord approval process. Before collecting rent, two approvals have to be required. The tenant approval, the PHA reviews tenant voucher size, income qualification, payment responsibility. B, the unit approval. The PHA must approve rental amount, rent reasonability test, unit habitability, and lease terms. Understanding the money, understanding payment standards. The rent reasonability test is very something you have to learn. The tenant portion versus the housing authority portion, you need to understand that, how that works. And then security deposits. These are not paid by Section 8. Landlords cannot collect market rate deposit and first month's tenant portion sometimes. So you got to keep in mind, inspections too, what you must be ready for in Section 8: passing housing quality standards, functioning smoke and CR detectors, no chipping and peeling paint, functioning locks and windows, safe handrails, working utilities, no leaks, mold, electrical hazards. You got to understand the lease and the contracts and compliance, standard leasing, housing assistance payments, HAP contract with the PHA, right? It has to mirror landlord tenant laws, align with PHA requirements. You got to understand rent increases. They must be submitted to the PHA. Increases must be reasonable based on comps. Dealing with tenant issues, right? Non-payment of their portion, lease violations, excessive damage, or illegal activity, right? You got to keep an eye out. Section 8 does not protect the tenant from eviction for that. And in some markets, you lose the voucher altogether. So the cash flow and the financial strategy, these are primarily C class neighborhoods, workforce housing. I was at a mayor's meeting in Newark, New Jersey. They're trying to push that narrative. They want workforce housing and affordable housing. There's a lot of vacancy areas where they can fill. So a lot of things to keep in mind. And some common mistakes to avoid is accepting a tenant before knowing the payment standard, missing, different items that can delay months of rent, and assuming voucher rent equals market rent, not screening properly, allowing side deals, illegal and very risky, and not planning for an annual inspection repairs. Key success to Section 8 landlording: treat it like a partnership with PHA. Keep units inspection ready, over communicate, document everything, screen tenants thoroughly, learn local PHA quirks, budget for repairs and re-inspections. Section 8 is not a loophole, it's a system that rewards well-run properties and penalizes poor management. Felix, good morning and welcome. Thank you for your patience. Brief overview: who you are, what you do, and thoughts to the Section 8 loophole in real estate investing.
Joe, Grand Rising, everybody. Thanks for having me as always. Buchanan Biz Enterprises, the Felix Group, and the team leader of the Keller Williams Legacy team. I've been dealing with Section 8 since 2006. So whether them, BRHP, different housing voucher programs, it's a great system. I've had one issue with a tenant ever. I think that was Section 8, and she never made it into a property. The screening, I'm very good at screening. Most of the properties, I had a lot of landlords and still do that, will call me that to put voucher holder tenants in their properties. I have a few of the vouchers holders that I've helped our properties. The HAP contract, all of what you said is help the landlord with all that, filling it out. The inspections are very simple, but just like Brian said, if you already just take pride in making sure that your property is in order, then you really don't have to worry about that. It's just basic, making sure that the toilets, all the waters, everything is running correctly, shower, sink, cabinets, everything is adjacent to the wall, it's secure. So as far as all of those things go, it's simple. Again, like you were saying about the regular process, as far as dealing with the regular tenant is different because they're like, even without them doing the numbers, it's really based off of whether 1 bedroom, 2 bedroom, 3 bedroom. Certain areas, Section 8, like in Baltimore County, if you have a 1 bedroom, you can get a 2 bedroom as long as it's within the same price range. In Baltimore City, they don't allow that. The rents are very competitive. They pay on time. Even if you have a tenant that doesn't pay their portion, and the water is also a big thing that's separate that you can take them to court for and evict them if they don't pay their water. The process of eviction is different when you're dealing with a Section 8 tenant versus a regular tenant because it's handled on certain days. So there's just a lot with it that I think that it's great. It's a great system. Like I said, they pay on time. I've had no issues with them. I've been dealing with any voucher programs, like I said, since 2006. And I've put a lot of those type of tenants in the properties. Properties are always great. Make sure that everything is in order. And they do yearly inspections just to make sure that the tenant is complying with the guidelines as well as the owner. I've had some owners where I may have come into the situation after the fact, or I've had to help the tenants with the fact that they'll do abatement if the owner doesn't take care of the proper things. So it's just a win-win situation all the way around. So I have no qualms with it, and I help a lot of investors with it. So that's my knowledge and wisdom for today.
As always, dropping nuggets, my friend.
Yes, sir.
I appreciate that. And I'm the last two gentlemen that were on here are actually capital partners with me at Lend Investors Capital. They are official broker, white label brokers for us. So I'm very happy to have Brian and Felix on board. Very happy to be part of, hopefully help them do very well with their client base in their markets. We're going to get to what top 25 cities do I see in the U.S. as a small real estate investor to identify for Section 8 rentals. I think this article is posted on LinkedIn. You could go find it. You don't need to go chase me down. It's all there. All these articles are posted. So I put together a data-driven investor focus list of top 25 U.S. cities for Section 8 rentals based on high Section 8 demand, long wait lists, strong rent-to-value ratios, stable payment markets, payment standards, landlord-friendly or neutral regulation. Neutral still just as good. Growing population or strong job markets, and solid cash flow opportunity for small, mid-sized investors. That 1 through 20 space. And that's where most of us are, right? We're comfortable with that. This list isn't the biggest cities. It's where the small investors actually win with predictable cash flow. Number 1, Cleveland, Ohio. Number 2, Pittsburgh, Pennsylvania. Number 3, Philadelphia, PA. Number 4, Baltimore, Maryland. Number 5, St. Louis, Missouri. Number 6, Detroit, Michigan. Number 7, Milwaukee, Wisconsin. Number 8, Indianapolis, Indiana. Number 9, Kansas City, Missouri, Kansas. Number 10, Columbus, Ohio. 11, Memphis, Tennessee. Number 12, Birmingham, Alabama. Number 13, the Atlanta suburbs of Georgia, meaning Clayton, Douglas, and DeKalb counties. Number 14, Tampa, St. Petersburg. Number 15, Jacksonville. Number 16, Houston, Texas. Number 17, San Antonio, Texas. Number 18, Dallas, Texas. The secondary suburbs, Garland, Mesquite, and Arlington County. Number 19, Chicago, south and west suburbs, Cook County, as specifically. Minneapolis, St. Paul, Minnesota. Number 21, Rochester, New York. Number 22, Buffalo, New York. Number 23, Hartford, Connecticut. Number 24, New Haven, Connecticut. Number 25, Las Vegas, Nevada. Certain zip codes and some sleeper markets. Now, these are the markets I feel like they're so underrated, right? Omaha, Nebraska, Dayton, Ohio, Scranton, Wilkes-Barre, Pennsylvania, Fayetteville, North Carolina, Tulsa, Oklahoma, and I like Chattanooga, Tennessee. Melissa, good morning and welcome. Thank you for your patience. Brief overview of who you are, what you do, and thoughts to the Section 8 loophole in real estate investing.
Hey, good morning, Joe. Good morning, Clubhouse. Thank you so much for having me up here. I am Melissa King with Busy Bee Virtual Solutions. We are a national virtual assistant company who support investors, solopreneurs, small businesses, and family caregivers in the areas of bookkeeping, back office admin, and I'm also a Michigan notary. My husband and I also invest in real estate and personal loans with our self-directed IRAs currently. We didn't save enough for quote unquote retirement, but I don't think I'm going to retire. I think that's a bad word.
It's overrated.
I actually love this because I personally am a Head Start honey. Okay, my family started out on assistance, and today I'm looking out over a parcel land from my $500,000 home near the Lake Shore of Michigan. Okay, so it is possible for someone to start on, what do you call it, Section 8 housing voucher program, PHA. It gives people a chance to improve their lives, okay? I'm living proof of that. Now, as a virtual assistant for many real estate investors and doing their bookkeeping, I do see my clients using a mix of Section 8, commercial, Airbnb. I also have a couple of clients who use property managers to collect, and I've got DIYs who like to use Section 8 and do it on their own. As a matter of fact, I just posted for one of my DIY clients a Craigslist ad, and he specifically wanted a Section 8 person. He went through 2 property management companies over the last several months. They did all of the proper screening, and the tenants still didn't pay, and he was unhappy. So that's why he took it back, and he asked me to just help him. He's a 72-year-old gentleman. He's been in the city of Grand Rapids for a very long time, making a lot of money off of Section 8 and his rentals. And that's where he feels comfortable. That's his lane. He likes it. And I would say don't shy away from it. Definitely, if you want to diversify, if you have a problem with the sad stories, which is what gets a lot of people in trouble, use a PM. Let them be the heavy. That's what I got for today, Joe. Thank you so much.
My pleasure. I listen. I'm a big believer in a couple team of experts that you need to have in your repertoire as a small real estate investor. One is bookkeeping, and one is property management. If you're not having a discussion with a bookkeeper in keeping things in check, you're not really you're not keeping it together. So let me give you an example. I am going to be announcing. I'll announce it now. It doesn't matter. But December 1, I'm opening up a title company, and it's going to be called Invest Abstract, and it's going to be licensed in New York, New Jersey, PA, and Florida. So the key thing to me was having bookkeeping in place, because my bookkeeping on title prior to that was just sloppy. It was just very messy, very sloppy. I have a full bookkeeping service addressing it internally with the title company and the abstract company. So now I know exactly who needs to get paid, how they get paid in the marketing program, because we're going to have a marketing program as well. So if you submit a title order, you'll get a fee, a referral marketing fee back in those states. So I said, listen, it's going to be a lot of 1099 work and a lot of paperwork. I'm like, I need a bookkeeping system in place. Like, no problem. We're going to have it all. And you're going to break it all down. You're going to know what and how to pay these people. And I'm like, yeah, because if I don't do this, it's just going to be, I'm a lender. I'm not a title person. So I got to make sure it's seamless so I don't lose myself in the madness. So taking on any business outside your major lane, I think bookkeeping is so important now than ever before, because it'll just get lost in the sauce, all of it. And the same here with the Section 8. You need to stay in touch with your PHA, whoever you're working with. Like, you should be going to their meetings and just getting face to face with people, because all that's going to do is help you. It's not going to hurt you. Okay. And as long as you're civil and professional, they appreciate that. They don't want to deal with slumlords. They want to deal with real people. They want to deal with people that are going to take responsibility and be accountable for their actions. That's how shit gets done. That's how things get done. I was at an event yesterday and they're like, wow, you're very direct in your answers. I'm like, what other way you want me to do? You want me to tell you stories and lie to you? No, but I mean, you're not so nice about being direct. I said, there's nothing nice about being direct. I'm just being direct. This is what it is. Oh, okay. Well, they want to be lied to. They want to be bullshitted. Real estate is not an industry of bullshit. You gotta sift through that. You gotta have a very good radar for bullshit. Okay. So you really need to really understand this space, because I know investors that have done extremely well in the Section 8 space. They will not rent to anybody else. They don't care about market rent. They just want Section 8. Joe Martelli's away this week, but if he was on, he'd tell you he bases everything, all his cash on cash returns, all his NOIs on Section 8. He does not concern himself with market rent. He concerns himself with the local PHA and what are the things that need to be done to solidify that unit to be rent ready for Section 8. Jeffrey, long time no see. Well, thank you for staying up here for a few minutes. Brief overview, who you are, what you do, and thoughts to the discussion, the Section 8 loophole in real estate investing.
Hey everybody, hello, my name is Jeff Morales. I'm a real estate investor in San Antonio and in Philadelphia and outward counties, Bucks and Delaware County. I own a few rentals and properties back and forth between Texas and Pennsylvania. I have, I'm also an aviation guy. I'm not a full-time investor. I have a full-time job, but I do this on the side. It's really fun, and I love meeting all the great people and Joseph and all those people that can really just kind of, again, just get through the nonsense and the bullshit. Like, how many conversations me and Joseph had where it was just a lot about bullshitting and a lot about people that are bullshitting people, and just kind of got to get the sense of it. As somebody who's been doing it now for like 6-7 years, I see that you got to be careful with a lot of the different deals and structuring and all the things that happen with real estate. So trying to get lost in the bullshit and the glam and stuff, it's really difficult to suss out. So I always appreciate that from Joe. Really kind of a straight talk, can get yourself in a lot of trouble with real estate. So, but anyways, about this Section 8, I think or Joe was talking about how it was a federal program run by municipalities, which is so true, because I can tell you that this San Antonio, Texas housing district does not act like the Philadelphia housing district, and the Philadelphia Section 8 does not act like the Bucks County, which is only like 5 miles away. So I will tell you that you have to get to understand the laws between the different municipalities and what they're looking for, especially when they inspect your unit. Because, I've had hinges that were loose and they're like, oh, that's it. You failed your inspection. I'll be back in 3 weeks, And in Philly's case, it's like back in like 2 months. But you have to really know the laws and know what they're looking at when they're doing the inspections, because that's what's going to really cost you money. When a Section 8 is working and it's on just like full time, you don't really notice, the checks come in the mail, boom, 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 boom. But that first few inspections, and if you miss those, that's really starts getting on your nerves where you're missing out on payment because maybe inspection's bad, or the tenant called the city and said, hey, this is not working, and they're trying to make sure the fixes are right too, because you can have somebody fix a sink and maybe it's not fixed to the right code or right specifications, and next thing you know, you're not getting paid that month either. So just really understand the laws and what you're actually dealing with when you're dealing with these multiple municipalities. I wish Section 8 ran the same like it did all over the country, but it doesn't. It's run by the municipalities and the townships. So So really get to know those people and get to know those laws. I guess one point that I haven't heard about is the resale value of a Section 8 property. As a person that's wholesaled before, I will tell you that investors that are looking for Section 8 properties that are well equipped, that are fully inspected, ready to go, have tenants in place, have long-time tenants in place, those houses tend to sell very well for in the investor market. Now, you're not going to get the highest ARV maybe out of that in that area, but you'll definitely get at least a good sale price from making sure that's in that DSCR realm. And so they can actually, make some profit on some of these high yield things that you can do on Section 8. So I like the Philadelphia market for myself for Section 8, even though it's a hard place to get into as a Section 8. I always have a property manager, and in Philadelphia, they allow the property managers to manage Section 8. So I think that's really helped me in that space. And the zip codes I really like in Philadelphia are those ones like 19124, like basically down in north to northeast Philly is kind of where I love that Section 8 market, because it's just, as soon as you put yourself out there as a landlord that does Section 8, and you get phone calls nonstop, just people of just trying to get into any type of unit as a Section 8 person. So for me, that's really all I care about Section 8. It's a great program. You got to do your due diligence, and you got to really understand what municipalities are asking for when they do their inspections. I know San Antonio actually puts out a video that you can go onto the website. You can actually see what they're looking for in order to get a Section 8 property inspected, and how to get that past the inspection process. So, but yeah, just be careful and look. Make sure you do your due diligence when you're trying to do that Section 8. So that's all I got.
Jeffrey, thank you. It's always good to hear from you. I hope all's well, and I do like when you post things in regards to the helicopter work. When you post on LinkedIn, by the way, all the time, as much as I can when I see it.
I'll do more, Joe. I think I'm trying to get into the more leadership space in my right now. So I'm now getting, with the teams and the metrics and the KPIs and all that stuff as an investor I've been doing for years. Now it's like, oh crap, this is actually real deal business that I'm really getting into. So that's always fun to see.
Great stuff, man. Thank you. And Jeffrey brought up some good subpart key risk and headwinds that will affect resale value. A lot of these Section 8 owners have owned properties for years, so like they might not even have a mortgage. So I would run all my numbers at 7%, which is the industry standard for the last 40 years, and see if the numbers work, because rent growth is modest. The market dynamics vary greatly by geography, right? The quality and class of asset matters, right? And changing policy risk. You got to know what PHA is doing so you can kind of stay ahead. In 2026, how I would kind of look at the resale value of Section 8, if somebody's trying to sell one, how to model it toward you. Again, the income stability is a plus. You got to look at your NOI, and you got to look at your DSCR, because you got to look at it, realistic, use a bad rate and see if it works, right? You got to understand your geographical market, because like Philly is much different than Rochester, much different than Baltimore, and Baltimore is definitely different than Philadelphia. All these smaller cities have their own little quirks. You got to get inside there. You got to meet your property management company. You got to build your team out, right? Rule of thumb: you gotta look at making X amount of dollars per month per door. And what is that for you? Like, what is that number? Like, I can give an example. I know clients of mine that do not buy Section 8 turnkey unless they're making $500 a month net profit. Now, some of them are self-managing versus property management. So $500 a month is very aggressive, putting 20% down. So they really need to know their numbers. Is that possible for you in your market? Do you have to look outside your market is the question of the day. So these are some thoughts to think about when you're looking at Section 8 as an opportunity and or the loophole in real estate investing. Good morning, Stephen. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to our discussion, the Section 8 loophole in real estate investing.
Hey, thanks, Joe. Thanks for everything last weekend. I can't wait to get signed up or officially on board with the lending program. My company is reihomepage.com. That kind of connects all my different brokerage and wholesale and investing and actually property management company. And we actually run it internally almost the same way that you're describing. Even though Kelly runs our management company, I do the acquisition, she does the management. She takes a quick look at something before we close on it to make sure she's okay with managing it. But we try to keep it separate. That way, it's just as if you're hiring a third-party manager. So that's definitely important as is bookkeeping. And in our market in Pennsylvania, it's funny Scranton is still on the top of or on that list, maybe not on the top of it. Market in Pennsylvania, there is no requirement to take Section 8. I know in many states, my mother was a landlord in Boston area, and we had to take it. There was no choice. Section 8 shows up, they win. That I don't think is fair because it didn't allow us back then to do the same screening. We screen our Section 8s the same way we screen our regular tenants. There's no option in our area to get on the Section 8 list. It's still a randomization, so you can't say, I want to be just a Section 8 tenant. You can try to focus there, but not. We love them. We don't take almost any other, I think she takes 2 or 3 now, assistance programs like CEO will do for the first month's rent and security, but all the other ones in our area have burned us over the years. Section 8 never has. We run our background checks on our tenants the same way, and truthfully, when we're buying property, the 2 properties that are in front of you guys now, Joe, for lending, we use the Section 8 fair market rents as determining what our baseline is. Can we do better? Maybe. But if we can do it for FMR, we know that we can do it. We know that there'll be somebody out there at that rate. And really, the fair market rates in our area have been equal or maybe even slightly better than what we would expect for market rent. Yeah, the inspectors can be weird. One thing that we say in our area for the Section 8s is the city inspection is about safety. The Section 8 inspection is about the more minor stuff, the squeaky hinges, the peeling paint on the outside windowsill on the 3rd floor. That's where our local Section 8 inspectors tend to catch you. So you really do have to run a bit of a tight ship, but none of it's absurd. I think the most absurd I had was they wanted us to paint the 3rd floor attic, which nobody could get to. But, that was 1 in 20 years. So really, I think Section 8 is a great baseline. I hope the new proposed changes in the federal budget don't change it as much as it sounds like they might. They're talking about wholesale changes in how much the program has for money. I believe there does need to be more auditing. I believe that there is some creative usage of Section 8, like mixed-use households. We're not all the Section 8ers. But I just hope that, those of us who invest and those of us who want to provide affordable housing, I hope the future doesn't change it too badly. But truthfully, also the other thing is, I have found, I think the lady who spoke earlier, that she came from Section 8 and built up. I've found most of our Section 8 tenants, not all, never all, but most of our Section 8 tenants have been very hardworking, usually with full-time jobs or some kind of job, but also they've been great people. They've been trying to do the best they can in whatever situation they're in. We really haven't found any more scams, any more bad tenants in the Section 8 pool than we have in the regular pool, because we screen them the exact same way. They have to meet our lease and the Section 8 lease. So you have to sign Section 8's lease in Pennsylvania, but you can also have them sign yours with over and above criteria that they have to be better than what Section 8 requires. So that's pretty much how we do it. Hopefully it helps out somebody out there.
Steve, so what's your thoughts that you guys are one of the sleeper cities? Like what's your feeling about that?
Well, I mean, I'm not surprised at all, simply because we are still, although prices have gone absurd recently, compared to when I started buying in 2008, we still have a great return on investment, and our Section 8 still works quite balanced. It's not landlords, our courts are not landlord friendly, they're not tenant friendly, they're very balanced. I'm not quite sure what you mean by sleeper city. Is sleeper city sort of your list rather than this other list, or how do you come up with a sleeper city?
I have data that you don't have.
Okay, all right. Yeah, I mean, I was a little surprised because when I started buying in 2008, I could buy and finish a unit for $30,000, and now you're buying and finishing a unit for nearly $100,000. A lot of what I enjoyed years ago kind of is gone as far as buying the market, but there's still good 10, 12, 14% cap rates out here. But I mean, I wasn't surprised because we've had such phenomenal quality of Section 8 personnel.
Mm-hmm.
And that's the other thing is one thing I found, and this is not town to town. Section 8 is very weird here. It's not like a large blob. Different towns have Section 8s, and the county has Section 8. It's all kind of mixed together. It all depends who your inspector is, who your caseworkers are. And we've had very good luck that the people on the Section 8 side have been protecting their clients, but have also been very fair to what we need. So I guess I wasn't terribly surprised.
Yeah.
I was a little surprised when I did. We got that far down the list, and then all of a sudden Scranton came out. But I wasn't really too surprised. But was there a trigger that made us? I mean, was there a trigger that put Scranton there? Because people have been telling me other markets that weren't on your list were good. So I'm kind of curious.
Yeah, there's a couple markets that make me nervous. Like Chicago makes me nervous. St. Louis makes me nervous. Certain areas of Baltimore's still a tough market to digest. I'm just being honest. You know what I mean? There's certain markets that weren't on there that catch that like certain areas in Michigan. I mean, obviously Milwaukee was mentioned, but I think there's other markets in Wisconsin that I think are pretty good. Minneapolis definitely a sleeper market to me. Nobody talks about it. It gets a lot of bad press, but I think Section 8 is good there. I see Philadelphia. I see problems in Philadelphia right now, like a city like Philly, because I have colleagues that are in Section 8. They can't get people to show up to look at the properties. So who's grabbing these PHA vouchers? So my concern is in some of the cities, PHA is becoming the landlord and literally backdooring the small landlord. They're becoming the landlord. They're buying buildings and filling up their own vouchers first. They're prioritizing because they want to control the narrative a little bit. It's whatever their prerogative is, because they're fully funded by the state or the Fed or the city to do this. So I see some cities having problems. Some of the smaller investors having problems competing with the same person that's paying them. Okay, which is PHA. So that's my concern. I don't think that concern is out in the Stratton market, Wilkes-Barre market. Definitely not in the Hazleton market either. Lehigh Valley, I like Lehigh Valley a lot, but you don't have to go Section 8 in Lehigh Valley. You can get market rent. You can grab that opportunity. So that whole corridor, I find very different than most markets throughout the country. You know what I mean?
Yeah, exactly. And not to interrupt, sorry, but in Luzerne County at least, they are slowly. I thought they'd already liquidated them all, but they're selling off the last few of their Luzerne County Housing Authority owned properties. I came across a couple properties I was looking at. I found out they were owned by the housing authority or whatever. So like our area is actually getting out of it.
Yeah, I'm going to tell you why. I'm going to tell you why, Stephen, and it'll make sense. The suburbs want to stick to market rent. They want to, because people are migrating out of the urban settings from a criminal perspective, standard of living, cost of living, quality of life. So those areas are going to become more suburb and market rent oriented, right? Your urban cities throughout the entire country, small or medium-sized cities, they're going to become your rental markets, and you're not going to have as much house buying. You're going to have much more investment house buying. Like people are not going to buy to live. They're going to buy to rent. They're going to move to rent from a Section 8 perspective in a lot of these urban settings. They're pushing the first-time home buyer and giving like 105% to a lot of these people to come back into the cities, but it's only a certain demographic that can't afford the suburban market. That's just called what it is, okay? And that is going to be a very interesting hybrid over the next several years in the urban settings, because you're seeing major flight out of a lot of these smaller, medium-sized cities based on education, schools, kids, etc., all this, because these cities are becoming more rental markets. And now your competition from a small investor landlord is competing with the same group that's paying you. So who are they going to take care of first, you or them? Right? It's only common sense. It's not. You don't need to be a rocket scientist to figure this out. So I appreciate your insight today, but I figure you get a good chuckle out of my list that I put together in data.
Yeah, I definitely love this. Now, what I'd love to see, some homework for you or for somebody, is line up DSCRs next to each one of those counties, or next to each one of those cities.
So what is the question? What is the question?
Basically, which ones have the highest? If you go Section 8, which ones have the highest return on income return? ESCR, cap rate, whatever the flavor is. That's something I'm actually going to task my BA to see if we can figure out which cities are the best returns.
In small to medium sized cities throughout the U.S.
And specifically on that, from that list, take that list and run it down and say, okay, I get a better return buying in Rochester. I get a better return buying in whatever, Scranton or wherever. I'm just curious whether it would impact someone's buying or not. I don't know. I'm just curious how those cities sort of line up next to when you're buying something that would be a Section 8 rental. Which ones have a higher return?
Yeah, I'll put my thinking cap on for you. Okay. My pleasure. So, this ties back to our discussion here, and it ties into PropTech, ties into automation data. Why will property management matter even more in 2026? Key drivers. Broader PropTech property management transformation is going to be significant in 2026. Right now, all fixed to rent, fixed to flip, and new construction loans are now AI. They are no longer needing to use an appraiser. DSCR, I would predict, my personal prediction is we're doing AI appraisals by second quarter of next year. So it's going to be all online work. They're going to eliminate industries because for the most part, it's aging. And the property management companies that embrace the PropTech space are going to be the ones that are going to have fewer headaches with their out-of-state landlords specifically. Bottom line, 26, I think property management is a core operational lever. It's not going to be a back office afterthought. It's a front and center in underwriting, investor communications, and exit strategy. If anything, its importance will increase relative to past years as markets normalize and investor focus shifts from rapid acquisition to operational execution. Amy, good morning and welcome. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to the Section 8 loophole in real estate investing.
Good morning, Joe. Morning, everyone.
Was that a good lead-in?
That was a great lead-in. That was awesome. I was like, I guess I'm up. So the way he's talking, as I get Miss BB. I am Amy Palvido. I am the chairwoman of the U.S. PropTech Council, which is the Real Estate Technology Industry Association in the United States. We are also have chapters forming in Canada and Mexico, so I guess we're the International PropTech Council. And I also been a longtime investor. I've been a real estate investor since 2008. I've been in construction and real estate since 2003. And I had, when I had single family homes, I had Section 8. When I had big, large multifamily properties in 4 states, I had Section 8. It was always a component of what we did because I was in workforce housing. So you always had some variant of Section 8. And I will say Stephen is correct. You can be in one market and have a very different experience with the PHA than in another market. And they could be like 5 miles from one another. The getting to know who's at your public housing authority is probably the best way to manage anything with Section 8. But I will say, I think, with as they get wind, and they're also always understaffed. So I don't think it'll be very long for HUD to, start making these improvements in property management and start using more AI. I think that's probably right around the corner. Especially if there's, we got to navigate through another government shutdown, which I hope we don't have to, but I think everybody will start embracing this. AI and property management looks and feels it's taking on certain things. So I'll talk about 3. One is maintenance. You can now, I expect the PHA to be able to walk through, or even have a tenant walk through with their phone, and as their video, and then just talk on the video about what they're seeing on the inspection, and then return that in, and that would turn into work orders. And that's all done by AI. And there's a startup in the council that does that now. He does it for multifamily. I would have ventured to guess that PHAs would start using that technology as well. So then the inspection process can speed up. That was the main thing when I was in Section 8. You're almost fighting the PHA, and you're just like, do you not want to get people in housing? Like, let's work through on this inspection process. Let's talk about it while you're here. Let's solve this problem while you're here. Right? Why do you have to not have me in the room? I mean, why can't we have not an adversarial relationship? Why can't we have a cooperative one? I'll fix whatever you want me to fix. Right? Let's just kind of walk through it, but don't make it so painful that you have to show up a month later. You want people in housing, don't you? So it's an interesting thing, but I think if you can use technology to take some of the adversarial or points of adversary nature kind of away by using tech, I think is great. The whole thing around AI and the leasing process, right? That's the easiest way. So, people can virtual tour, and I think that'll solve a lot of different problems. But your PHA is not going to use anything different than you wouldn't use in multifamily anyway. They're going to use it, but they're just going to have different requirements. But I think it's going to be a different feature, and I'm excited to hear, Joe, that AI, your lending community is willing to accept an AI appraisal.
Oh yeah,
I think that's going to move the transaction needle. I mean, it's going to move everything faster. Especially, right now we're not transacting much, but can you imagine in 3 years?
Yeah,
it's going to be crazy town, and I'm glad they're moving there now.
It was all talk. Okay, suddenly all the fixed to rent, fixed to flip, new construction has become virtual. And you can take an optional appraisal, but wouldn't you think AI is more precise on comps? I would think you're going to get a very precise number here. I don't think you're going to have this 10% variable working against you. I think it's going to work in your favor, actually, because the minute you have a personal opinion to an appraisal, they're missing comps. They're missing market rents. They're missing things. This is going to capture the whole narrative. So, okay, so if we're embracing that there on the construction side, almost 100%, right? How far are we away from DSCR being virtual AI done on appraisals? How far are we away from desktop?
Yeah, that's it, right? How do you determine your ARV? Why isn't AI doing that, right?
Well, if we're determining it from an ARV perspective, we're not far away from the DSCR recertification of that appraisal if it was already done virtually. So I think by second quarter of next year, that's a prediction. That's mine. I think we're going completely AI between DSCR and RTL. RTL is the abbreviation for fixed to rent, fixed to flip, and or new construction. So I think all of it will be encompassed by some form of PropTech by second quarter. All of it.
Yeah. Yeah, and I think, on your draws and the inspections, I know y'all take pictures now and you'll kind of accept that as the work's been done, right? There's so much room for people to do, shady things there. Yeah. But if you do, but the camera technologies now, you can tell on the inspection process, if you used an app and they had to use their phone to do this with, you could tell if the texture was bad on the wall. The cameras are so good now that you're gonna, if you force them to use an app with a camera and they had to walk around and show you what was actually happening, you would have a really good sense of, you could make sure that there's less and less fraud that way. Yeah. You could have a pen, they're at the house, they're walking into the house. You could assure that what they're showing you on the camera is truly that property. And then you could actually, with the camera technology now, get a real good sense of exactly what's been done in there. From even on the paint on the walls, you could tell that it was done poorly. It's amazing now with camera technology what you can do.
Yeah,
for sure.
I agree with you. And what's our discussion today in the follow-up meeting? The room.
I'm just going to give an update on kind of some new tools that are coming out for real estate. So that's the next room.
Excellent. Full nickel of content. I love it. All right. So last but not least, Miss Linda Pelagas of Realty 411. Good morning. Welcome from the West Coast. Brief overview who you are, what you do, and thoughts to our discussion, the Section 8 loophole in real estate investing. Linda, are you there? Hey, good morning.
Yes, good morning, Joseph. Good morning, everyone. My name is Linda Pliagas. I'm with Realty411.com. We're an information and news website for real estate investors. And we also produce magazines, both digital and print, as well as events, both virtual and in person. It's a pleasure to be with you today, Joseph. Thank you for having this discussion. I love Section 8. I've had numerous Section 8 tenants in so far 3 states, California, New Mexico, and Texas. The property managers that I had lined up in those areas worked directly with Section 8 housing. And I have to say, I don't have any complaints. I found the program to be wonderful in regards to always receiving payment on time, and they also procured responsible tenants for us. The only, I guess you could say, drawback is that every year they do inspect your property. They do a thorough inspection, and they do, have a list of items and things that you will have to correct and remedy before they renew the lease. A lot of landlords may not like that control and checkup every year, but as a long distance landlord, I didn't mind it at all. In fact, I welcomed it because it was a way for me to find out what was needed to be done in those units. And it was also another way of a third party verifying some of the repairs that needed to be done. So I didn't have to solely depend on the property manager and what they were saying. I was also getting reports from another party, which was also very welcoming when you're a long distance landlord, because you can't fly in every single month to see what's going on. So that was a good thing. I really don't have any complaints about the Section 8 housing. For me, it was a positive thing for me and my family. We still work for Section 8 for one of our properties in California, and they recently raised the rent, as far as they're going to be paying more money for our tenant, which means her income may have gone down a little bit in the past year. So what they do is every year you have to reapply for Section 8, and they can see your income and see if anything has changed. And then they will base the help on the income of the tenant, who's a Section 8 tenant, and they will either, pay more or pay less depending on what their income is for the year. But overall, it's been a very positive experience as a landlord, and I would encourage other people to also get into the Section 8 program as well. Back to you, Joseph.
Thanks, Linda. Anything coming up in regards to Realty 411 we should need to keep an eye out, whether virtually or in person? Linda?
We're going to be having a virtual event tomorrow, as a matter of fact, all about tax liens, how to buy tax sales, properties with tax issues. This is a great way of buying properties at a very low cost. In fact, I'm going to be introducing you to this gentleman, Joseph. Maybe you can have him on the show, because he buys tax sales in numerous states, and he's been able to buy a property, a house, for as low as $5,000 utilizing tax sales. So we're going to be having that webinar tomorrow, Monday, at 6 p.m. Pacific Standard Time. We're also having an in-person event December the 6th in Pasadena, and everyone's invited. So please join us. For more info, check out realty411.com. Thank you.
Thanks, Linda. Yeah, we're scheduled out right now to January 4th with subject matter. So anything after January 4th, I'll be putting new content, new subject matter in. So if anybody has something they would like to hear, please reach out to me directly, not on Clubhouse, but email me or email me or text me some subject matter that that might hit the point for you and what you're doing in your business. And thank you, Linda, for coming on this morning. So my final thoughts to Section 8. For the small real estate investor in 26, I think in 2026, Section 8, the housing voucher program continues to stand out as one of the most resilient and predictable strategies for small real estate investors seeking stable cash flow, consistent occupancy, and resistant assets. While the broader market is adjusting to interest rate normalization, shifts in consumer affordability and tightening credit, Section 8 rentals offer a blend of reliability and long-term demand that few other rental models can replicate. So, these are things that you want to keep in mind. Definitely sit down with your property management company in whatever market you're looking at. Definitely attend some PHA meetings to see, are they cannibalizing your tenant inventory? That's a concern I would have as a small investor. You're not going to be able to compete with a federal housing authority if they're cannibalizing the voucher. So you gotta have a concern there. I would be concerned as well. I think this was a great subject this morning. I want to thank everybody for their time. I want to thank Linda Plodge from Realty for One being a supporter of our group and the moderators here today. I want to thank Mr. Yarnell Perkins of Perkatech. Without him, this would not be in existence. He's one of the best social media guys I've known, administrating my Google team and postings and updates and newsletters. It's just amazing what he's done for me and our business as partnership in this podcast. I want to thank MB Capital Solutions, always supporting and co-sponsoring various events with me throughout the year. I'm a referral partner for them for the past decade in unsecured business lines of credit. If you have an interest in becoming a referral partner, please reach out to me on that as well. And then I want to thank Lend Investors Capital, where I'm a direct private lender, providing capital for direct to investors. I'm also setting a true white label program for your capital partners that want to broker our money. And then I have an unbelievable new referral program where I can pay just real estate professionals up to 1% in referring clients to me, and we could talk about that on a one-on-one or Zoom call. But I think it's another revenue stream as a real estate professional. You don't have to disclose. I'm paying your entity. It's all very clean, very corrected, and very integrous. So if anybody has any interest in that, my link is right above. You can connect with me at any time. My quote this morning: skills are cheap, passion is priceless. Gary V. Everybody have a blessed Sunday morning. Great week. We'll see you next Sunday morning, 9 a.m. Eastern Standard Time. Follow Amy into the next room, and I'll be ending the room in the next 30 seconds. And thank you.